What if your safest investment isn't as protected as you think? With global trade tensions heating up, new tariffs could shake the market, and they may already be targeting key sectors in your portfolio. One popular fund, SCHD, has long been seen as a reliable dividend-paying powerhouse. But how well can it really hold up when the rules of international trade keep changing? In this video, we'll break down exactly how tariffs can impact SCHD, what's at risk, what might actually benefit, and how you can stay one step ahead. We'll unpack which sectors are most exposed, look at the ripple effect on dividends, and explore which companies inside SCHD could thrive or stumble. No fluff, just clear, powerful insights you can use. Stick around to the end because understanding these shifts might be the difference between growing your wealth and watching it shrink. Experts warn that nothing is truly shielded from the turbulence ahead. Every asset is vulnerable, and delaying action could cost you. The global financial system is always in motion. Recently, trade barriers, especially tariffs, have started playing a much bigger role. These fees can directly impact the performance of your investments, so learning how they function is essential. In this breakdown, we'll spotlight a widely followed fund, SCHD. The Schwab US Dividend Equity ETF, commonly known as SCHD, is a favorite amongst income-focused investors. It seems dependable, but here's the bold question. Can any investment truly escape the reach of tariffs? Chapter 1. What SCHD represents. Let's get into it. SCHD is structured to reflect a specific benchmark, the Dow Jones US Dividend 100 Index. Picture it as a curated list of America's top dividend-paying firms. But not just any company qualifies. To get in, a business must meet certain requirements. For starters, it needs a stock market value of over $1 billion. On top of that, it must have consistently shared a portion of its profits with shareholders in the form of dividends. SCHD's purpose is straightforward: give investors access to reliable, high-quality dividend stocks. It aims to deliver strong returns while keeping risk contained. How? By sticking tightly to that index. No guesswork, just discipline. That makes it a clear and focused option for long-term investors. The index behind SCHD follows a specific set of rules. It evaluates a company's financial health and compares it with similar businesses. It looks closely at things like dividend strength, payout growth, and overall market stability. This selection process builds a portfolio made up of around 100 strong performing companies. Chapter 2. How tariffs shake things up. Now let's break down tariffs, because they're more important to your investments than most people realize. A tariff is basically a fee added to products bought in from other countries. When a government sets one, it raises the cost of those imported goods. This extra cost affects not only businesses that rely on those imports, but also everyday consumers who buy them. Lately, tariffs have been making a comeback. We saw this happen when former President Trump introduced trade penalties on items from countries like Mexico and Canada. He also targeted Chinese products and even metals like steel and aluminium. Moves like these shift how global trade works, and the ripple effects can be huge. Tariffs don't just hit one item, they often trigger bigger problems. They can shake investor confidence, increase market swings, and slow down global economic growth. All of this creates unpredictability for businesses and investors alike. It's like tipping the first domino. Everything else can follow. And here's the key: some areas of the market are hit harder than others. Industries like manufacturing, materials, and industrial goods are especially vulnerable when trade barriers rise. Some industries depend heavily on international trade. Sectors like technology and manufacturing rely on smooth, global supply lines. So, when new trade taxes hit, these operations often take the biggest hit. Added import costs can raise business expenses, and when production becomes more expensive, companies may hike their prices. That can cause buyers to spend less. Let's say tariffs raise the price of steel. Any company using that steel will likely see higher costs, which may trickle down to the consumer. This chain reaction matters, especially for investors. Chapter 3. Breaking down SCHD's investments. To really grasp how vulnerable SCHD might be, we need to examine where its money is placed. As of April 2025, SCHD spreads its capital across multiple parts of the economy. Consumer staples lead the way, making up around 20% of the total. Then come sizable portions in energy, manufacturing, medical services, and consumer-focused brands. Here's a quick overview. Consumer staples make products we use every day, like groceries, cleaning goods, and personal care items. Energy includes oil drillers, gas producers, and fuel distributors. Industrials create tools, equipment, and other physical products. Healthcare companies offer treatments, medicines, and health services. Consumer discretionary businesses sell non-essential goods, things people buy when they have extra money. So why is this sector mix important? Because certain parts of SCHD's portfolio are more at risk when tariffs are enforced. For instance, industrial firms often depend on importing parts and exporting finished goods. When trade restrictions are added, their costs rise and operations get complicated. Energy companies might also feel pressure if fuel becomes more expensive to import or export. Consumer discretionary businesses could be hit if shoppers pull back due to rising prices. The goal here is to connect the dots, which sectors SCHD holds and which ones are most exposed to trade disruption. By doing that, we can better understand how much of the fund could be at risk. We'll also zoom in on some specific companies inside SCHD's portfolio to see how those individual businesses might be affected by future tariffs. Chapter 4. Weighing the risks and upsides of SCHD. Now let's dive into the real question. How could tariffs impact SCHD both positively and negatively? Let's start with the risks. Trade taxes can be a real obstacle. One major issue is how rising costs could affect the companies inside SCHD. If those businesses face higher expenses due to tariffs, their profits might shrink. And what could directly impact their ability to keep paying or increasing dividends, which is a big reason why investors choose SCHD in the first place. We also have to look at possible outcomes. What if tariffs continue to rise? Or what if tensions ease? Both situations could play out very differently for SCHD. If things get worse, we might see bigger market drops, especially in the sectors we already know are sensitive to global trade changes. There's another threat too: retaliation. When one country adds tariffs, others usually respond with their own. This back and forth can spiral into a trade war, and when that happens, US businesses that rely on international customers can take a hit. Many large American companies earn a lot from sales outside the US. But it's not all bad news. There are also chances for SCHD to shine. Some of the companies in its portfolio don't rely on global trade. They serve mostly US customers. If imported goods become pricier, those domestic-focused businesses might actually gain an edge. Plus, SCHD leans on well-established, financially strong companies. These firms often have solid cash reserves and a steady leadership, which can help them stay stable during global uncertainty. And here's one more thing. When growth slows down, like it might during trade-related slowdowns, dividend and value stocks like those in SCHD often do better than fast-growth tech stocks. So, while there are clear risks, there's also real potential. It all depends on how global events unfold and how prepared your investments are. To better understand how SCHD could react to future trade disruptions, we can review how it behaved during earlier trade disputes. While previous outcomes don't ensure future success, they can offer valuable clues. In the end, smart investing means recognizing both the dangers and the possibilities, and making choices that match your financial comfort level and long-range vision. Chapter 5. Smart moves for today's investor. So, how should you move forward from here? Here are some thoughtful suggestions. 1. Dig deeper. This video offers a strong overview, but it's important to take a closer look. Explore the companies inside SCHD. Figure out how exposed they are to global trade issues, both directly and indirectly. 2. Keep learning. Trade rules and international deals change fast. Follow updates closely so you can respond quickly if things shift. Being alert gives you an edge. 3. Don't rely on just one path. Spreading your money across different investments helps balance your risk. Consider mixing in other funds and asset types to avoid being hit too hard by one sector's struggles. 4. Stay focused on the big picture. Trade issues may affect short-term performance, but investing is a marathon, not a sprint. Stick to your long-term strategy and don't panic over short-lived market swings. In summary, SCHD does include companies in industries that may face challenges from global trade barriers like energy, industrials, and non-essential consumer goods. But some holdings may actually benefit, especially those that sell primarily within the US. And since SCHD concentrates on reliable income-generating businesses with strong financials, it may hold up better during market stress. The global trade environment is always shifting. By staying updated, thinking long-term, and diversifying your approach, you give yourself the best chance to grow steadily, no matter what headlines bring. Thanks for being here. Make sure to like, subscribe, and please share this with someone who needs to hear it. Your financial future is built one smart step at a time. Here's to your investing success. Profitable investing.